Okay, so volatility rise. So volatility rise. So there's two things that we like about this. We find stocks that have, consistently had their volatility run up going into earnings. So we have that kind of anchoring the strategy where it shouldn't get too big of losses if it goes flat. And I think I have an example of one that it just stayed flat and kind of, hurt. But, as long as if this thing moves, a decent amount price wise, within that window, then, it's going to be a winner. So the worst thing that could happen for this trade is it just kind of lolls along kind of flat without moving. You want this thing moving. So that's really the thing that we look for on this. So we're also looking for a 25% gain, and you can do a straddle, but all of our testing we've pretty much done kind of resulted in us just focusing on the strangle, and I'll show you an example of that. But the straddle is going to cost a lot more versus the strangle, so you can get more trades just doing strangles versus straddles. So we're looking within a 20-day window, and same thing. We just look for, and we do set a stop on this one, based off of testing, and always put in your your limit order when you get in there. So the strangle's the optimal. It'll cost less. Sometimes, especially for higher price stocks, it's going to be a lot less than, buying a straddle for Google is going to be much, much more expensive than buying a strangle. So, so it helps with the risk management just to focus on the strangles. Like I said, if it moves significantly in either direction, it's going to be a good trade. And we covered that. So here's the strangle that we look for. So we test this also, from 20, I think, all the way down to 3 days prior to, and we're looking for a 25% profit, and we have a 50% stop loss on this. So we're also looking 60 days out, helps minimize any kind of time decay. So, that vol rise should offset any kind of time decay for the most part, should help. And what we do, we buy a call and a put. So the straddle would be buying one at the money. So wherever the current price is, you buy it right next to that, the call and the put at the same strike. Here we're buying at the upper and lower standard deviation. So, based off of the expiration, it's going to have different standard deviations for like a 30-day expiration or a 60-day. So that's all available in the system, and it's pre-populated with the trade alerts that we send out. But you can always look it up on the on the system. So that's going to be a lot cheaper than the other. And that one standard deviation is like 60-something% chance it's going to stay within that range. So if it does move quite a bit, then it should be a fairly easy winner based off of that. So our candidates that we screen, so we're looking for at the money implied volatility. So 10 days out, it moves at least 15% higher, 7 out of the 10 last years. So this is an example, stamps.com. Excuse me. You can see, consistent, done pretty well as far as, the IV, and this is like a 20-day IV from last quarter. It gets up there pretty high. Sometimes a lot higher than others, but obviously the higher the better on the volatility rise for the strangle trades. So this one was a 20-day entry prior to earnings, long strangle. This had 100% win rate as of last quarter. So what happened? The worst thing that can happen for a strangle trade last quarter. So this one was a loser. It did hit our stop here. But basically, this is exactly what you don't want to happen when you have a strangle going into earnings. Pretty much just stayed flat. So that would be a losing trade, obviously. Last quarter for this, pretty pricey. So I'm not sure too many people did it. But overall, it's been a good strategy, good trade, except for the last quarter. So. So this time, it still populates, this time instead of 20, it's down to 19. So if you've been trading this, I'd say continue trading it, just because the lost one, it still meets all the criteria, and obviously it's done a lot, made good money over time. So that one populated this time. Good profit factor, little pricey, so it might be outside people's price range, on a risk per trade basis. And that's something Sudhir talks about. And we fully advocate, sticking to a certain amount you want to risk per trade. And, if it gets outside of that, just you can trade it virtually. Like Google is probably outside people's price range, but obviously been a good trade, but sticking to that that risk per trade amount is very important. So for this, we have 6 trades that had back tests of 100%, 17 over 90 and 45 over that 80%. So this is also prior to earnings, so you really have to pay attention to the earnings announcements. And then, as far as the live trading, you can, we always advocate to put in that limit order to close it out for 25% profit. Here, you can also put in a stop loss if you want for 50%. Some people prefer to watch it and do it manually. So, it's up to you what you want to do there. But always, for this trade, you still want to get out prior to the earnings release.